Okay, so let me ask you something a little uncomfortable. You get your paycheck at the end of the month. You look at the number, and then you look at what actually landed in your bank account, and you just sit there for a second because a huge chunk of it is just gone. Taxes, Social Security, Medicare, state, local, and you didn't have a choice. It was already taken before you even touched it. Now, here's what I want you to think about. Elon Musk, Jeff Bezos, Warren Buffett. These guys are worth hundreds of billions of dollars, and in multiple years where their net worth went up by literally billions, they paid close to zero in federal income tax. Some years, literally zero. How is that possible? And more importantly, and this is what nobody talks about, some of what they're doing, you can actually do too. Not all of it, but more than you think. Here's the thing. Most people assume that billionaires have an army of shady accountants doing something illegal in a basement somewhere. And so regular people just kind of accept their tax situation. They shrug and say, well, I'm not a billionaire, so I have no options. And they leave thousands, sometimes tens of thousands of dollars on the table every single year. That frustrates me because the tax code isn't a secret. It's public. It's written by the same Congress that you vote for. The rules are available to anyone who knows where to look. Billionaires didn't discover a cheat code. They just actually read the manual. So today, we're going to read the manual together. Let's start from the very beginning, because I think most people fundamentally misunderstand what gets taxed in the first place. You work a job. You earn a salary. The IRS calls that ordinary income, and ordinary income is taxed the hardest. In 2024, if you're earning over $609,000 a year as a single filer, you're paying 37 cents of every dollar to the federal government, before state taxes, before anything else. Now, here's where it's interesting. Billionaires, almost by definition, do not earn a salary, or if they do, it's laughably small. Tim Cook, CEO of Apple, one of the most powerful companies on earth, his base salary is $3 million, which sounds huge until you realize the rest of his compensation is in stock. Jeff Bezos paid himself $81,840 a year as Amazon CEO for years. That's less than a lot of junior software engineers. Why would the richest people in the world pay themselves almost nothing? Because salary is taxed as ordinary income, and stock, or more precisely, the increase in the value of stock, is not income at all, not until you sell it. And if you never sell it, it's never income, ever. This is the core of the whole thing, and it has a name. It's called unrealized gains, and it is the single biggest reason why the tax system works so differently for billionaires than it does for you and me. Let me give you a metaphor that makes this crystal clear. Imagine you own a painting. You bought it for $1,000. Over 20 years, it becomes incredibly valuable, and now it's worth $10 million. On paper, you made $9,999,900. You are, for all intents and purposes, very wealthy. But you haven't sold the painting. So according to the IRS, you have made exactly $0. You owe exactly $0 in tax. Now here's where it gets wild. You go to a bank. You say, hey, I have this painting worth $10 million. I need a loan. The bank says, great, here's $5 million. You take that $5 million. You live on it, you invest it, you do whatever you want with it. Is that loan income? No. A loan is a liability. You owe it back, so you pay zero tax on it. Now you've got $5 million in your pocket, a painting you still own, and a tax bill of zero. That, in simplified form, is what billionaires call buy, borrow, die. And it is completely, utterly, 100% legal. In 2021, ProPublica published a bombshell report using actual IRS data that was leaked to them, and the numbers were staggering. Between 2014 and 2018, the 25 richest Americans saw their collective wealth grow by $401 billion. $401 billion of new wealth, and on that, they paid $13.6 billion in federal income taxes. Sounds like a lot, right? Until you do the math, that's a true tax rate of 3.4%. Meanwhile, the average American worker, the one getting a paycheck every 2 weeks, pays an effective federal tax rate closer to 13 to 14%, plus payroll taxes, plus state taxes. You could easily be handing over 25 to 30% of your total income if you add it all up. And Elon Musk, in 2018, he paid $0 in federal income tax. Zero. Because he didn't sell stock. He borrowed against it instead. Warren Buffett, who has literally said publicly that he thinks the rich should pay more taxes, paid an effective federal income tax rate of just 0.1%. Not 10, not 1, 0.1%. His secretary famously paid a higher rate than he did. And Buffett's not hiding this. He talks about it openly because he's not breaking the law. He's following it. Okay, so let's get into exactly how they do it, mechanism by mechanism. Because once you see how the machine works, you'll start to see the levers that ordinary people can actually pull too. The first mechanism is what we just talked about, unrealized gains. You own an asset, it goes up in value, you don't sell it, you don't pay tax. This is the foundation. The second mechanism is the capital gains tax rate. Here's something most people don't know. In the United States, there are two different tax rates for investment income. Short-term capital gains, which is when you sell an investment you held for less than a year, are taxed at ordinary income rates, so up to 37%. But long-term capital gains, investments held for longer than a year, are taxed at a maximum of 20%. For most middle-class Americans, it's 15%, and for people below a certain income threshold, it can be 0% tax, legally, on investment income, if you hold long enough and manage your income carefully. Now, that 20% max rate that wealthy investors pay, compare that to the 37% that a high-earning doctor or lawyer pays on their salary. The system is literally structured to tax work harder than wealth. I'm not saying that to be political. That is just factually how the code is written. The third mechanism is depreciation, and this one is wild. This one is where real estate investors, not just billionaires, but regular millionaires and even middle-class landlords get to do something that sounds almost illegal when you hear it for the first time. Let's say you buy a rental property for $500,000. The building itself, not the land, just the building, is valued at, let's say, $400,000. The IRS says, great, that building will wear out over 27 and a half years. So every year you can deduct $14,545 from your taxable income, just because you own the building. Even if the building is actually going up in value, even if you're collecting rent and the property is cash flowing beautifully. The IRS calls this depreciation, and it can turn a profitable rental property into a paper loss, which then offsets other income. And there's an even more aggressive version of this called bonus depreciation and cost segregation, where you can accelerate that deduction and write off a huge chunk of a property in year one. Real estate developers do this constantly. This is one of the biggest reasons real estate has been a wealth-building vehicle for decades. It's not just appreciation, it's the tax treatment. The fourth mechanism is something called qualified opportunity zones. This one is newer, came out of the 2017 Tax Cuts and Jobs Act. The idea is that if you take capital gains from one investment and roll them into a fund that invests in designated low-income areas, you can defer and in some cases eliminate those capital gains entirely. The fifth, and this is where the ultra-wealthy really pull away, is charitable giving. Not because they're giving money away for nothing, but because of how they give. See, when a billionaire gives a stock to a charity, they get a tax deduction for the full current value of the stock, but they never have to pay capital gains tax on the appreciation. So if Elon bought stock at 1 and it's now worth $1,000 and he donates that share to a charity, he gets a $1,000 deduction, but he never pays a cent of tax on that gain. And if they're really sophisticated, they don't even give directly to a charity. They put the money into something called a donor-advised fund or a private foundation, which gives them the deduction now, but lets them direct those funds over years or decades. Bill Gates has given away hundreds of billions of dollars through the Gates Foundation, and while doing so, he's gotten tax deductions that reduced his personal tax liability substantially. Now look, I want to pause here because I think some of you are feeling frustrated, maybe even a little angry, like this is so unfair. And I get that. I understand that completely. But here's the thing I need you to hear. Getting angry at the system without learning how to work within it is the most expensive choice you can make, because the tax code isn't going away. The people who complain about it and do nothing save $0. The people who understand it and take action, they save thousands, sometimes hundreds of thousands. You don't have to be a billionaire to use these strategies. You need to understand them. That's step one. So let's talk about what regular people can actually do, because I promised you actionable advice, and I'm going to deliver. Strategy 1. Max out your tax-advantaged accounts. I know, you've heard this before, but I am genuinely baffled by how many people leave free money sitting on the table. Your 401k, your IRA, your HSA, these are government-sanctioned ways to reduce your taxable income right now. In 2024, you can put $23,000 into a 401k if you're under 50. That's $23,000 that the IRS cannot touch this year. If your employer matches and you're not contributing enough to get the full match, you are literally turning down free money every single year. Stop doing that. And the HSA, the Health Savings Account, is the most underrated account in America. It's triple tax advantaged. Your contributions go in pre-tax, they grow tax-free, and you withdraw tax-free for qualified medical expenses. Nothing else in the tax code works that way. Nothing. Strategy 2. Invest in index funds or ETFs and hold them for the long term. This isn't just good investment advice, it's a tax strategy. When you hold a broad index fund for years, you defer gains indefinitely. You don't pay capital gains tax until you sell. And when you do sell, if you've held for over a year, you pay that lower long-term capital gains rate instead of ordinary income rates. This is exactly the same principle that billionaires use scaled down for normal people. Strategy 3. If you own a side business, even a freelance gig, even a small LLC, you have access to deductions that W-2 employees do not. Your home office, your equipment, business-related travel, professional development, a portion of your phone bill. These are legitimate deductions that reduce your taxable income dollar for dollar. A lot of people are scared to claim these because they're afraid of being audited. But if you have a legitimate business and legitimate business expenses, these deductions are yours by law. Talk to a CPA who works with small business owners. One conversation could save you thousands. Strategy 4. Real estate, even small-scale real estate. Owning a rental property, even one property, gives you access to depreciation. And if you become what the IRS calls a real estate professional, which requires 750 hours per year in real estate activities, you can use those paper losses to offset even your ordinary income. This is a legitimate path that thousands of people use every single year to dramatically reduce their tax bill. Strategy 5. Tax loss harvesting. This is something that sounds fancy, but is actually pretty simple. At the end of the year, if you have investments that are sitting at a loss, you sell them. You use that loss to offset gains you've realized elsewhere. And you can even offset up to $3,000 of ordinary income per year with investment losses. Then you buy back something similar. Not the exact same security, due to something called the wash sale rule, but something comparable, and you stay invested. You've taken a loss for tax purposes without actually changing your investment strategy. Now, let me go back to the buy, borrow, die strategy I mentioned earlier, because I want to explain the die part, because this is where it gets truly mind-bending. When a billionaire dies, their heirs inherit their assets, and when they inherit those assets, something called a stepped-up basis applies. This means that all of the unrealized gains that accumulated over that person's lifetime, the stock that went from 1 to 1,000, are essentially wiped clean. The heir's new cost basis is the value at time of death. They can immediately sell everything and pay zero capital gains tax on decades of growth. So the strategy in full: buy assets, borrow against them to live on, never sell. When you die, pass the assets to your children. They inherit with a stepped-up basis. They can sell everything immediately. The gains that accumulated over an entire lifetime are never taxed. This is legal. This is in the tax code. This has been in the tax code for decades. ProPublica estimated that this stepped-up basis loophole allows wealthy families to pass on approximately $40 to $50 billion in untaxed gains every year. Every year. Here's another thing that most people don't realize. The complexity of the tax code is itself a strategy. The U.S. tax code is roughly 2,600 pages long, plus Treasury regulations that interpret it, which run into the tens of thousands of pages. A billionaire can afford to pay a team of the best tax attorneys and CPAs in the country to read every single one of those pages and find every single advantage. You and I are using TurboTax. This isn't about cheating. It's about information asymmetry. The rules are the same for everyone, but the knowledge isn't. And knowledge, in this case, is literally worth money. This is why I want you to take this seriously, not to be bitter about billionaires, but to actually learn. Because even if you implement one or two of these strategies, you could save hundreds of dollars, thousands of dollars, tens of thousands of dollars over a lifetime. That is real money. That is retirement money. That is your kids' college money. That is a down payment on a house money. Let me tell you about a concept called the wealth flywheel, because this explains why the rich keep getting richer. And it's not just because they're lucky or well-connected, although sometimes that helps. When a regular person earns money, they pay taxes on it, then invest what's left. Their investments grow, they pay taxes on the gains, and they reinvest what's left after that. Taxes are leaking out of the system at every step. When a billionaire earns, or more precisely, when their assets appreciate, they don't pay tax immediately. That untaxed growth compounds. When they need cash, they borrow against the assets at a low interest rate. The interest on that loan is sometimes tax deductible. The compounding continues untouched by taxes for years, decades, generations. The difference in outcomes over 30 or 40 years is staggering. It's not just about the tax rate, it's about the timing. Money that compounds without being taxed grows exponentially faster than money that gets taxed at every step. This is Einstein's eighth wonder of the world: compound interest, supercharged by tax deferral. Now, let me address something that I know some of you are thinking. You're wondering, isn't this going to change? Aren't politicians going to close these loopholes? Fair question. And the honest answer is maybe. There have been proposals. The Biden administration proposed taxing unrealized gains on the ultra-wealthy. Several senators have put forward versions of a billionaire minimum tax. None of it has passed, and the reason is complicated. Part political, part constitutional, part practical. But here's the thing. Whether or not policy changes, you need to act under the current rules, because right now, today, these strategies are illegal, and the most expensive thing you can do is wait for someone else to solve this for you. Billionaires have tax attorneys on retainer specifically to adapt to whatever the law says at any given moment. They are not worried about policy changes. They will always find a way. That's not cynicism, that's just reality. The only way to not be completely at the mercy of a system you don't understand is to understand it. Okay, let me pull this all together because I want to leave you with something concrete. The reason billionaires pay so little in taxes is not luck. It is not cheating. It is a set of deliberate legal strategies built around one central insight. Income tax is a tax on income. And if you can build wealth without generating taxable income through asset appreciation, through borrowing, through deferrals, you can legally sidestep huge portions of the tax code. The core strategies simplified. They earn through asset appreciation rather than salary because unrealized gains are not taxed until sold. They borrow against assets rather than selling them because loans are not income. They use depreciation, especially in real estate, to generate paper losses that offset taxable income. They give to charity in the most tax-efficient way possible. They hold assets until death, allowing heirs to inherit with a stepped-up basis and wipe out a lifetime of untaxed gains. And for regular people, you do versions of all of this scaled to your life. You max out tax-advantaged accounts. You invest for the long term and hold. You take every legitimate business deduction available to you. You consider real estate. You harvest losses strategically. You work with a good CPA, not just a tax preparer. A CPA who does actual tax planning throughout the year, not just at filing time. The difference between a tax preparer and a tax planner is the difference between someone who records your history and someone who changes your future. I want to end with this. There's a story, I don't know if it's apocryphal or not, about a journalist who asked a famous investor how he managed to keep so much of his wealth. And the investor said, "I don't avoid taxes, I defer them. There's a big difference." Deferral is everything because money deferred is money that keeps compounding. And over time, that compounding is what separates the people who build real wealth from the people who stay exactly where they are. You don't have to be Elon Musk. You don't have to have $1 billion. You just have to start. You have to take one of these strategies and actually implement it. Open that HSA, max that 401k, talk to a CPA, research a real estate investment, look at your portfolio and think about tax loss harvesting. Because here's the uncomfortable truth that I want you to sit with. 5 years from now, you're going to be somewhere. The question is just whether you'll be somewhere different from where you are today or exactly the same place. And the people who stay exactly the same are almost always the people who understood the problem, who watched the video, who learned the thing, and then went back to whatever they were doing and never changed a single behavior. Don't be that person. You're smarter than that. You watch this whole thing. You clearly care. Now go do something with it. Take one step, just one, and let that be the beginning. If this helped you see the tax code differently, share it with someone who needs to hear it. And if you want to go deeper into real estate investing, into tax strategy for freelancers, into building wealth on a normal income, hit subscribe because that's exactly what we do here every single week. See you in the next one.